Hello traders and welcome back to the Forex Geek. Today we are focusing on a crucial aspect of technical analysis that can significantly improve your trading performance. So we're talking about bearish continuation candlestick patterns, and these patterns are essential tools for identifying potential trade opportunities in downtrends. So by mastering these patterns, you enhance your ability to spot high probability trade setups and make more informed decisions in bearish markets. Throughout this video, we'll break down the most effective bearish continuation patterns. We'll explain their characteristics and show you how to incorporate them into your trading strategy. So stay tuned until the end to gain valuable insights that will elevate your trading game and potentially increase your success rate in the forex market. So what are bearish continuation patterns? These are patterns there are patterns on price charts or specific formations on price charts that suggest an ongoing downtrend is likely to persist. And these patterns typically appear during established downtrends and provide traders with valuable insights into potential future price movements. When you spot these patterns, they often indicate that sellers remain in control of the market and the price is likely to continue its downward trajectory. So these patterns are particularly useful because they offer a visual representation of the ongoing struggle between buyers and sellers in the market. So in the case of bearish continuation patterns, they show that despite temporary pauses or small rallies, sellers ultimately maintain the upper hand in the market at the time. So let's talk about common bearish continuation patterns we have in the markets. The first on my list is the bearish separating lines pattern, which is the one you're seeing on your screen right now. So this pattern forms during a downtrend and it consists of two distinct candlesticks that tell a clear story of market control. So let's break down what you should look for in this formation. The pattern begins with a strong bullish candle, and this is your first signal. This green candle shows buyers attempting to reverse the downtrend, creating a notable upward move in price. So what makes this pattern unique is the second candle. It opens at exactly the same price level as the first candle, but closes significantly lower. So this demonstrates that sellers are regaining control of the market. So when you spot these two candles forming in sequence during a downtrend, pay close attention. The equal opening prices between these candles are crucial. It shows that the market's indecision at that exact price level before sellers take command. So let's spot it in the charts. Let's quickly hop on the charts to spot this pattern. You can see this price had started giving us bearish price action, and we are looking to continue this trend, this bearish trend. And then we saw this bearish separating lines candlestick pattern, which we just discussed. First, we should have a bullish candle, a green candle, followed by a bearish candle opening at the same price of the open of the first candle, and also giving us a push down lower. So when you spot this candlestick pattern, it shows that we should continue the bearish trend, which is already at play in the market. This is the daily time frame, and looking at this bearish trend, this has been on for months, for weeks actually, since the beginning of the year 2022, all through when we spotted this pattern about 2 weeks. So looking at this, we'll be looking at to continue the bearish trend as we've been signaled by the bearish separating lines candlestick pattern right here. Let's look for another example. Let me quickly look for another example. Okay, this is another one. For additional market context, you can see here that we are bearish, and we should be looking for selling opportunities. You can see price giving breaks to the downside, break of structures to the downside. So this just means that we should be looking for selling opportunities to short because we are in a bearish trend. And now you can see this bearish separating lines clearly here, signaling that we should short. You can see the the first candle, which is the bullish candle, followed by the second candle, which is the bearish candle, and this candle closes, sorry, this candle opens at the same price level as the open of the first candle, as you can see. And also after that, the second candle dips further, showing that sellers are in control, they are regaining control in the markets, and we should be looking to short, we should be looking to sell after that. An ideal strategy when using this is to, if you are an aggressive trader or you are a swing trader, this is a daily time frame, you could just enter at the close below this below the bearish separating lines, and your stop loss should be above the second candle right here. You can set your take profits at a 1:2 or a 1:3 risk to reward ratio, or you could just target the support level right here. Remember, do not trade this out of context, always trade in line with the market trends. And also you could use additional technical indicators or price action to confirm your trades. So that is one way to use the bearish separating lines candlestick pattern. So let's look at the next candlestick, bearish candlestick, continuation candlestick patterns. The next on my list is the falling tree methods candlestick pattern. So let's go to the falling tree method candlestick pattern. Before we get into that, you can see another example of our bearish separating lines candlestick pattern. This is a clear bearish trend here, and we just saw this, we spotted this right here, and we could just be looking to enter at the close below that pattern. And you can see price gapping all the way right here, and we could be looking to short, enter a swing trade from here, or you could go to the lower time frames to spot entry setups in your lower time frames if you are not a swing trader. So target a 1:2, or you could just target a significant support level, in this case here. So that is for the bearish separating lines. Let's go to the next. The next is the falling tree methods, and the falling tree methods pattern indicates a brief pause in a downtrend before the bearish movement continues. Let's talk about its characteristics. First, you should have a long bearish candle, 3 small bullish candles contained within the range of the first candle, and then a final bearish candle that closes below the first candle's close. Below the first candle's close, this final candle should close below it. So this is your falling tree methods, and it is a bearish continuation candlestick pattern. So let us hop on the charts to spot this pattern and how you can use it in your trading. So you can see this perfect example right here. This was for a short term trade. You can see we are bearish right here. We are bearish, and you can see the first candle, which is the bearish candle, 3 small bullish candles. Remember what we just discussed, 3 small bullish candles contained within the range of the first candle, and then the fourth candle, which is the last candle of the pattern, closing below the close of the first candle. In this case, price actually gapped, this fourth candle actually gapped way below and closed right here. So just be looking for a short position. You could go to your lower time frames to find a better entry to ride this small move to the downside. Remember, this is the 2-hour time frame, and so you could go to the 15 minutes, or you could just enter right here. So enter your short position right there. So let's look for another example of the falling tree method candlestick pattern. Okay, this is one right here, and you can see this example is a good example. First, we have the first candle, the bearish candle. then 3 small bullish candles contained within the range of the first candle, as you can see, and then we have the fourth candle closing below the close of the first candle. This is your falling tree methods, and we should be looking to take a short position to trade this pattern. So this is the falling tree method, and that's how you can use it to trade the markets in a bearish continuation. So let's look at the next on my list. The next on my list, we'll be talking about the doji star candlestick pattern. So the doji star candlestick pattern, this is the doji star candlestick pattern, and it should be used in a downtrend. It can signify indecision before a potential further downward move. It's characterized by a long bearish candle, a long bullish candle actually, a doji candle where open and close prices are nearly identical, and a gap down below the first and second candles. This is it right here. This is the bearish doji star candlestick pattern actually. So the bearish doji star candlestick pattern can signify indecision before a potential further downward move. So let's hop on the charts and spot this pattern. This is the bearish doji star candlestick pattern, and you can see here we are bearish. This is the bearish market, of course. You can see characterized by several trend lines. You can see this trend line. See this trend line right here, showing that we are bearish, and we should be looking for bearish or selling opportunities to short this market. And looking at this, you can see the bearish doji star candlestick pattern right there. And first we have the bullish candle first, then the doji gapping above the first candle, the bullish candle, and then we have our confirmation candle, which is the third candle, gapping down below and closing below this first two candles. So when you spot this, you should be entering your short position at the close of the next candle, which should confirm your trade. Aggressive traders would like to enter at the close of the third candle. If you need additional confirmation, you could wait for a close below the entire pattern, and here in this case you just target a 1:1 or a 1:2 depending on your preference. Here we are clearly bearish, so this is a continuation pattern, and you could just target a 1:2 in this case, and this is your trade. So let's look for another example. You can see this one here, we are clearly bearish, and in order to continue this bearish trend, we'll be looking to look for selling opportunities in this market. You can see right here we had this pullback, and looking to continue this trend, we saw the bearish doji star candlestick pattern. First we have the bullish candle, then we have the doji star, that's the star right in the middle, and then we have a series of bearish candles closing below this right here. So this signals that yes, indeed, we should be looking for selling opportunities in this market. So you could enter at the close below this entire pattern right here with your stop losses above here, above the doji, and you'll take profits at 1:1 or a 1:2. Okay, so just gonna stretch it to the 1:2 actually. So that is how you use the bearish doji star in a downtrend. So the last on my list is the inverted hammer, the bearish inverted hammer. So while typically seen as a potential reversal signal, an inverted hammer can also indicate a bearish continuation if confirmed by subsequent candles. So it features a small body at the lower end of the trading range, a longer upper shadow or wick at least twice the length of the body, and also the last characteristic is little to no lower shadow or wick. So it can be bearish or it can be bullish, but the context is that it should be in a downtrend. It should be spotted in a downtrend and should be used for continuation. So let's hop on the charts and see how we can use this for continuations. This is the bearish inverted hammer, and right here you can see we are bearish. We are clearly bearish here. Price giving us breaks to the downside, have series of breaks to the downside, and we should be looking for key resistance levels like this one, and you can see price tapping into that, giving us a nice reaction, showing, confirming that we are indeed bearish and we should be looking to push to the downside and probably break this structure. So looking at that, zooming in, you can see several bearish inverted hammer giving us confirmations to continue this downtrend which is currently at play right here. And you can see the first one and the second one. Ideally you should enter at the close of the next candle, closing below that hammer, that inverted hammer. So ideally you should be entering around here at the close of that confirmation candle. Stop losses above the inverted hammer, and your take profit could be 1:2, or you could just target this support level right here. So I have another example here, and you can see in this case we have this key level, this key resistance level right here, and we have price tap into that level and give us a nice reaction. So we should be looking to continue to the downside to break this structure. This is a clear bearish trend. So, and on the way we can see 3 bearish inverted hammer which can be used for continuations. We have one here, have another one here, and we have another one here at significant tops. So you should know that we are in a bearish trend, so these areas could be used to continue your bearish trend. You can see this. In this case, this was a bearish trend line, and we have price tap into the trend line right here and give us this bearish inverted hammer right here. So that was a nice confirmation for entry, and you could just enter at the close below that inverted hammer. Stop losses above the hammer and the inverted hammer, and your take profits should be at a 1:2 or a 1:3, or you could just target the support level right here. So this should be used for continuations. This is another one, and you can see price closing below the bearish inverted hammer. So we just take our entries from there, stop losses above the inverted hammer, and you could just target this support level. So one thing you should know that is we should be bearish, we should be in a bearish trend, and we should have an established bias or a structure which we are aiming to break. As you can see in these examples, we are clearly bearish in the overall trend, and these are just continuations. We use the bearish inverter hammer as continuations to break this structure and confirm the bearish trend, using also key levels. And you can also use your Fibonacci retracements to spot the optimal points for a continuation in the present trend. So how to trade using these patterns? You should always confirm the trend, identify the pattern, then set your entry and exit points as we've discussed. Also manage your risk. Risk management is essential when trading any candlestick pattern. Even though these patterns can be reliable, no strategy is foolproof. Always use proper position sizing and risk management techniques. such as trailing stops or scaling out of positions to protect your capital. So by following these steps and combining them with other technical analysis tools, you'll be able to trade bearish continuation patterns more effectively and reduce your risk exposure. Alright traders, we've come to the end of today's video. If you found this video helpful, please hit the like button and subscribe to our channel. Don't forget to turn on the notification bell to stay updated with our latest forex trading insights and strategies. Thank you for watching, and we'll see you in the next video.